Welcome to Money Matters with Greg, where we dive into the money conversations shaping your life. From investments to estate planning, insurance to taxes, we cover it all with a fresh perspective. Join Greg and his guests each week to get inspired and take control of your financial future. Let's get started. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.
Hey, good afternoon. It's Greg Farrell, CEO and owner of Farrell Wealth. It's a wealth management firm here locally in Valparaiso, Indiana, and also helping clients in over 25 states on their wealth management needs and wants and wills. The show's Money Matters with Greg. We talk money on this show. Thanks for joining us today here as we go to celebrate our nation's birthday. July 4th coming up. The 250th is here. And looks like, all things considered, it looks like it's going to be pretty magnificent. So hopefully everyone's able to celebrate with their families. Thanks to all those that have served and given us the freedoms that we have and hold dear here, and have the ability to be able to have a cookout and enjoy family and do our things that we do here on July 4th and celebrate our great nation that we are very, very proud of and to be a part of. We're broadcasting today on WVLP FM, 103.1 FM on Thursdays at 1 o'clock, and then also on Saturdays as a replay at 1 o'clock. And then we also have podcasts anywhere you pod, Apple, Spotify, you name it. Our YouTube channels at Farrell Wealth. You can check us out there, as well as our website, farrellwealth.com. Many of the things that I talk about are on things I blog about as well, and you can find them out on our blog and see any charts that we are not able to obviously disclose here, but you can easily do. You can see on the blogs, but just excited to be a part of it. If you want to check out the WVLP family, go to wvlp.org and see many of the different shows that are just fantastic here. There's a great lineup. I'm the money guy, I guess, but there's multiple different things as far as arts to music, and a number of great DJs as well that spin some classics, as well as some number of other shows that are here. So very thankful and proud to be part of the WVLP family. And then also, like I said, podcasting everywhere. Last week, we went over the Federal Reserve, and how things have changed. It definitely threw some shockwaves into the market. Markets didn't necessarily appreciate the changes so much, just because of a lot of sell-off in regards to the AI world. And can be seen as this week in June, historically in the markets, is never a good week. So kind of used to it. But there's a reason why to pay attention, and just is it more of an opportunity than anything else as far as any sort of sell-off. We've had all the run-up going into SpaceX IPO and all the noise about that for sure. We obviously have the winding down of the Iran war, at least tentatively. So we're trying to muddle through that. Oil's come back immensely from over $100, $110 a barrel, down all the way down to below 75 now. So hopefully that'll help you on your July 4th travels, where you are not having to spend so much on gasoline, because it's certainly coming down. We think it's going to 60 as things progress here this summer. And ultimately try in this show to talk to you about money and how it can help you, where it can guide you, where you can grow it and protect your money and add some wealth. And I wanted to go into some estate planning conversation here today. Obviously not a lawyer, don't play one on TV. So there's my disclaimer. And I highly recommend you consult with all your tax professionals and estate planning professionals and financial advisors in regards to some of the things we're going to talk about today. But I do want to talk about, we work with a number of clients that have used mechanisms that not necessarily everybody's so familiar with. They're nothing new, but as far as just not knowing, there's some things that I thought I might want to bring up about the transfer of family wealth and what your options are in regards to coming up with a plan to discuss transferring your wealth out of your estate to the second generation, third generation, and where it might go, what your wishes are, whether it be philanthropic, charitable inclinations, or, just basically just trying to come up with a plan that will minimize taxes to the next generation as much as possible. And I did a blog on this just recently. You can check it on our website, farrellwealth.com. Also on all my socials, I blogged it out as well. And I hope you enjoy sort of, that blog and then many of the other couple charts on the blog that you can mention or you can check out. You won't have necessarily the ability to see here, but I hope this helps you in some of the things that we see in our high net worth individuals and families that we work with as we're trying to work with, okay, here's a problem that we'd like to solve, at least to minimize, not necessarily saying that all taxes are not paid or unpaid or avoided in any way. That's not to say, but there are ways to be able to plan that could help relieve that tax burden to the next generation so they don't necessarily get hit with a big tax bill. And you, having passed away, come back from the grave because you're so mad that so much money went to Washington, which is typically the case in most people's wants. They'd rather have their money go to their family than go to the government. So, for many people, the wealth they have accumulated over a lifetime is more than just about money. It represents years of hard work, discipline, and overall sacrifice really to ensure that you have a comfortable retirement. You want to take care of your families and even more. There's many more things that everyone has. There's dreams and wants and wills that they think about. So one of the most important and often overlooked questions in financial planning is not necessarily how to grow wealth or even how to spend it, because certainly our clients don't have a problem with that or using it on things. I've seen some crazy things. I always say if I was in the business of judging, I'd be out of business because I see some crazy things and what people spend their money on. But how to pass it on efficiently and intentionally is really the conversation we want to have today. So this requires thoughtful estate planning that really covers a broad range of financial topics. It's going to include taxes, it's going to include goals, and it's going to include legacy. So let's go over those things as we move forward here and we talk about this today on the podcast. And really, despite the importance of this and this planning, 2025 survey found that fewer than 1 in 3 Americans report even having a will, and more than half say they have no estate plan at all. Now, we've had estate planning attorneys on this show, and many of them have said, or they readily agree. I mean, they run into a lot of people who don't even have a will. I do too. And the advisors here at Farrow Wealth run into it all the time, where there's no estate plan at all. There's, I wrote it on a napkin and my sister knows, or, oh yeah, I've been wanting to get around to that. And again, if we were business of judging, we'd be out of business. But this gap really between this intention and action is significant. And without the thoughtful structure in place, wealth that took decades to build can be eroded by taxes, legal complications, and unintended distributions that were a mistake, just because you didn't have a plan. So I'm here to tell you, let me be that person on your shoulder that reminds you, or whispers in your ear here, that you might want to plan. In the state of Indiana, everyone has a will. In your state, if you're listening from elsewhere, which I hope you are, from other states, as we represent clients in over 25, every one of those clients has a will in that state. Every one of those states is happy to make you, happy to help you with your distributions of your wealth because you didn't plan accordingly and have just a basic last will and testament. So advanced estate planning addresses the challenge that might be by creating really a coordinated approach designed to maximize the efficient transfer of assets to people and causes that matter most to them. Now, for many people that don't have a lot of wealth or don't have a lot of money or don't have whatever, they still have things they want to be able to disperse. So it's still important that you have a last will and testament. I say this all the time on the show too. But I really want to remind everybody, last will and testament, medical power of attorney, and living will. So last will and testaments, where does my stuff go? Who do I want to have that jewelry or whatever it might be, their heirloom or that grandfather clock or whatever it might be? Medical power of attorney is who pays for all the bills while I'm not doing well and I'm incapacitated or my wife and I are both incapacitated in the hospital. Is who pays the electrical bill, the mortgage, you name it, basic stuff. Medical power of attorney to be able to make sure you stay afloat while you're healing. And then living will, which is what are my wishes if I'm on machines and what do I want done? What do I want? What are my directives? So 3 simple basic things that most people don't even get done. And what we're talking about today is estate planning that's even a whole nother level, much a number of different levels, actually. So at its core, estate planning serves two broad purposes. First, it supports the non-financial goals, such as meeting the needs of the dependents, which we see quite often. Many people are in line waiting. They know there's money there. They know that there's wealth. There's also the protection of assets from creditors if there's an issue in regards to what money is owed, and ensuring that the assets pass to the right people the right way at the right time in the right titling, which is really, really important too. And secondly, it optimizes financial goals such as managing tax obligations that maintain liquidity, which is super important. So you don't have to sell your business or your farm for 25 cents on the dollar. And preserving the value of your business interest entirely is really, really important. These are all de-risking your business as a business owner, lowering the risk in regards to your business if it is purchased. You think any buyer would like to come in to see that the business owner and owners don't have financial plans? They don't have estate plan documents. They don't have buy-sell agreements. They don't have all these other things that they need. We're going to have to come in here and put these all in place. Like, that's not right. You need to be able to do that as a business owner. So these are all things that de-risk the business. And one of those things is financial plans. So the most effective plans that integrate both types of groups and goals that treat wealth transfer as a long-term continuing process is the correct way to do it. So it's not happenstance and it's not shock and awe. It's a continuous long-term process that considers all things involved in the right ways to be able to set it up. There are going to be options that come to you that you might be presented with that really don't fit your situation, but they might fit the family next door or the business owner down the street. So establishing the right framework for wealth transfers is very, very important. And before exploring specific strategies, it's really worth understanding the foundational decisions that make every estate plan. Now, these begin with three simple but important questions. So I'll leave you with this. All right. So what assets are being transferred, to whom, and when will that transfer occur? So three simple questions. What assets are being transferred, to whom, and when will that transfer occur? Now, the types of assets being transferred matters because it influences which transfer strategies are most appropriate. Again, choices. Some choices might work for you, some choices might not. But assets such as cash and publicly traded securities, including typical stocks and bonds, are the most straightforward way to transfer things to transfer because they are liquid. They can be sold. There's a secondary market that is going to be a market that's not just going to, unless it's some sort of stock that nobody's ever heard of, you're going to get a fair price. Real estate, closely held business interests, and alternative investments that would be, let's say, I've seen everything from an oil rig all the way to multiple different apartment buildings that need to be sold. And the alternative investments that introduce complexity because they're harder to value and maybe difficult to divide among multiple beneficiaries takes time. What is the valuation of that oil rig? What if they have 10? What if they have 20? What if they have 100? And are they located in different geographies? Are they in different states? Are more valuable than others? Whatever this might be. Like, these are things that have to be decided well before someone passes away and the estate plan kicks in. So every estate plan begins with creating a picture of who will benefit from the assets being transferred. Beneficiaries can include a spouse, children, grandchildren, other relatives, close friends, charitable organization, your best friend at the bar, whatever. I've seen it all. Each beneficiary type may call for different planning strategies. And this is very important when balancing the needs of the surviving spouse against the long-term interests of the children and future generations. So if you've got a Brady Bunch situation where there's 3 on one side and 3 on the others, and they're from other marriages, and now they've come together, like, how does that all get done as far as future generations? How do we make sure that my kids get what they deserve and my wishes? If I pass away and my wife remarries, what happens to their rights? Because that's really, really important. And you the same. Like, you need to be thinking of these things. So identifying beneficiaries early in the planning process really helps ensure that the right assets reach the right people in the most effective way. Now, the timing of asset transfers is another key consideration. So some assets pass directly to beneficiaries upon death. Many of those have beneficiary designations on the paperwork that everyone signs. And while others may be strategically distributed over time, that might be the best case. Now, Typically, anyone taking over for your estate as your executor might not necessarily have the expertise on when and how these might be distributed and not creating huge taxable implications. Hopefully, they have guidance. Most executors are part of the family or a family member to minimize on cost. If you are needed to get a trustee, trustees do swoop in and do take care of your interest. Now, there's a fee involved, but you're gone. So is it really, necessary to think about that when you're trying to pass on everything the right way that a family member might mess up? So it's something to consider. Again, it's up to you. It's your choice. But do mention it because we've seen it before where family members don't have the expertise to be able to distribute things the right way, and the taxable implication showed up because they were not titled the right way, or transfers were given, or checks were written, or whatever it might be. I've seen it all. So, for example, by making completed gifts over one's lifetime, a donor can really take advantage of annual gift exclusions that really increase the amount of tax-free transfers in your lifetime. So that's one of the ways to minimize it. In 2026, the annual gift exclusion is $19,000 per recipient. So that means you and your wife, you and your husband get to have that one combined. So times two, right? Basically meaning a donor can transfer property up to that amount to any one individual for $38,000 a year if you're splitting the gift with your spouse without paying any taxes and no disclosure as well. So this is all, once you go over that threshold, then it's got to be on your taxes. So now if you execute this over time, this approach can really remove a significant portion of taxable estate value and allows for greater intention over how and when beneficiaries receive their inheritance. I've seen it all as far as, my kids get 25, 30, and 35, and that's how they structure their trust. I've seen it all the way up to 65, which is insane, in my opinion. The one thing I want to say about this generation having a little bit of money in your 20s, in your 30s is, look, you might want to buy a house. Your lifestyle might change because you own a house and you have the ability to be able to have a down payment. There might be gifts that grandmother and mother and father could do to strategize pushing some of that money out to the kids throughout their lifetime that does help them get an advantage that some people might not necessarily have in this lifetime. So not having to wait until you pass away until they get that advantage. And maybe they don't have a place to use it. They could buy a business. They could franchise a business. They could do lots of different things if they're given a gift throughout time and could depend on that gift maybe over the next number of years, which you can do over a 5-year planning process per the IRS rules as well. So obviously want to make sure everyone's consulting their tax accountants, and attorneys, tax attorneys in regards to all this. Many of these things are on irs.gov. You can find it and learn more about on your own if you're a do-it-yourselfer, but highly recommend you get advisors in your life that are going to help you transfer strategies for these different goals and put this sort of together to help you with an understanding that foundational elements, those foundational elements are the next step, is to identify the goals that can be achieved through estate planning, map them to available options, and I want to give you some examples. So reducing the taxable value of a gross estate. For individuals seeking to minimize estate taxes due to taxes due while transferring future appreciation to the next generation, they really can reduce the value of their gross estate and ensure their beneficiaries receive distributions through irrevocable trust. Now, these are trusts that don't change. A common example is a grantor retained annuity trust, or a GRAT. Now, we use these quite often with many high net worth families, and GRATs are where the grantor transfers assets into the trust and receives annuity payments over a set term. And then if the grantor survives the trust term, the remaining assets pass to the beneficiaries outside of the taxable estate, though care needs to be taken as a gift taxation can apply. So you need to make sure that is obviously tracked. But it's a nice way to be able to set up assets getting moved out of the estate well ahead of time. And we see this in a lot of different real estate conversations with families that own multiple different homes throughout the nation. Now, achieving philanthropic goals is another choice. So for families with philanthropic goals, another option is reducing estate value through a charitable remainder trust, or CRT. This option allows the grantor to designate beneficiaries to receive the income interest for a set term and have the remainder go to a designated charity wherever it might be. So you can set up a trust that the beneficiaries get the interest that the trust dictates, and then ultimately the remainder goes to designated charities. In addition to removing the assets from the gross estate, this method provides a gift tax and an income tax deduction for charitable remainder interest. Now, this might be a great option if you have a business that you're about to sell. You're going to have a long-term capital gain that's huge, and in this year, you could set up a charitable remainder trust, donate the charitable money to donate to the charitable remainder trust, and then have options in the future with beneficiaries getting income and then also charities getting that money down the line, but you get the deduction initially. This would also be with donor advised funds, DAFs. It's sort of the same premise without necessarily as much work. We have donor advised funds. Any advisor can set up a DAF and help you with a DF. Now, but with the CRT, they work well with highly appreciated assets that can generate cap gains tax if you were to sell them, such as real estate or concentrated stock. And within the trust, the proceeds are reinvested in a diversified portfolio, and the beneficiary receives the income as stream for life for a specific term. And this approach converts really low yield, high gain assets into a tax advantaged income stream while achieving these philanthropic aims. So that's an idea as well. And then again, with the donor advised fund, that helps with the cap gain. You get the benefit of the cap gain, and you don't necessarily have the expenses of setting up the trust. And your family can then disperse the proceeds however you want. You can have family meetings over it, which I highly recommend. And there's solid effort as a DAF. So last thing, managing business interest. Now, for families with business interest or illiquid assets, additional planning around liquidity, governance, and all this continuity is essential. So buy-sell agreements, specifically how ownership transfers if an owner passes away or becomes incapacitated. This prevents disputes and ensures that the business can continue operating. Key person life insurance can provide liquidity to cover ongoing business operations or fund a buyout without requiring a forced sale of the business, which is important because if a spouse dies, you don't want to necessarily go in. You're a partner with a business owner, and you don't want to go into business with their spouses and their family. So a key person life insurance allows you to have a liquid event where you pay them off, you gather the ownership of the entire business, and then you ultimately can move on with your life while the family obviously is in mourning and goes through a process. You also have family limited partnerships or FLPs that allow senior family members to create a class of ownership and transfer ownership interest to the next generation while retaining control as a general partner. Limited liability interests lack control and marketability, so they may be eligible for valuation discounts that allow families to transfer more value within the gift and estate tax exemption limits. And also asset protection is an additional benefit, shielding family members from claims of potential creditors. There's always that risk. You don't know what's underneath the onion sometimes with business, so when you inherit it, it could be quite a mess. So this structure is really valuable in the context of a family business where continuity of management is really, really important as a tax efficiency manner. But I know we're running up against the hour here, and planning for wealth transfers really is, I just want to mention, it's a continuous process. It's like all financial activities. It's a living, breathing plan that's moving. Estate planning is a lifelong process. It really requires monitoring and adjustments as personal circumstances and fiscal policies change too. I mean, the tax code might change. So a common example of changing personal circumstances is family growth. An estate plan that is optimized for a young family will naturally need to be revisited as that family ages and grows. Now, when multiple future generations are involved, the complexity of wealth transfers to those beneficiaries increases as well. So one of the things that is another option is a generational skipping transfer trust, which is GST, is relevant in these sort of situations because it was implemented to ensure that transfers are taxed at each generation, and thus applies to transfers to recipients who are 2 or more generations younger than the donor. So with careful planning, a donor can reduce or avoid this additional transfer tax through various transfer techniques. I won't get into those today, but that's another option to be able to have. And then finally, policy changes really can reshape outcomes over time. The federal estate and gift tax exemptions have shifted significantly across many administrations, from as low as $675,000 overall as an exemption in 2001 to as high as $15 million per individual today. And this was all put in place by the 2017 Tax Cuts and Jobs Act, which doubled the exemption, and the One Big Beautiful Bill, which made really even higher threshold permanent. State level rules add another layer of complexity for sure, since some states impose their own estate on inheritance taxes with exemption thresholds that are different from the federal level. But residency, domicile decisions can all be thought about and talked about, and they can therefore have meaningful financial consequences for some families. It's really important to stay current on the policy changes that ultimately affect the estate tax calculations. And all these strategies work best when they're integrated with one another and with a broader lifetime gifting and philanthropic goal plan involved. Again, as with all areas of financial planning, the key to success is to start as early as possible and continuously refine your plan so it aligns with your goals. And ultimately, the bottom line is estate planning requires a coordinated approach designed to preserve wealth, reduce taxes, minimize taxes, and ensure that assets reach the right people in the right way at the right time. So I hope this was helpful. Time for WVLP 103.1 FM, which is where we broadcast on Thursdays at 1 o'clock, and then Saturdays replayed at 1 o'clock as well. Here Central Time, here locally Valpo. You can also get on WVLP.org and streams worldwide. And then any of our podcasts are on Spotify, Apple as well, anywhere you pod, plus YouTube on our YouTube channel at Farrell Wealth. Looking forward to a wonderful celebration of our nation's birthday here going into July 4th. I hope you have a very healthy and happy and profitable week. See ya.
Thanks for tuning in to Money Matters with Greg. We hope you gained some valuable insights today. Remember, your financial journey is personal, but you don't have to go it alone. If you enjoyed the show, be sure to subscribe and share. Until next time, here's to making your money work for you. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.